Welcome back. You're watching First Trades live on ET Now. Straight off, let's connect with Paresh Sukthankar, Executive Director of HDFC Bank. Paresh, good to have you on ET Now. Thank you for joining us. Paresh, let's start with the credit policy, which is due next week. What are your expectations given the recent revival in growth momentum?
Well, I personally believe that there's unlikely to be anything on the rate front, although I am hopeful that there could be a further 25 basis points cut in the CRR. So, although the RBI has been doing a fair amount of OMO, you still have LAF borrowings almost at 85,000 crores. And I do believe that a further reduction in that bank borrowing, the borrowing under LAF should help the overall rate movement in due course. So at this point of time, I doubt, I know everyone's hoping for and would love to see a rate cut, but I think I would more likely expect a CRR cut.
Right, Paresh, hi, morning. So how much rate easing do you expect in the whole of the year?
Well, if we don't have a rate cut now, which is what, like I said, I don't expect it, certainly in the Jan to March quarter, there is an expectation that you should see 25, maybe with a bit of luck, even 50 basis points of reduction. So that will really be in the Jan to March quarter before the year ends. And then perhaps as we get into the next fiscal, maybe another 25 to 50 basis points in the first half of the following year. So if you look at the next 9 to 12 months, or maybe 6 to 12 months, in fact, you could land up seeing somewhere close to 100 basis points of reduction, although it would clearly be staggered across 3 or 4 rate cuts.
Right, so Paresh, what kind of rate action could we expect from HDFC Bank on both the lending side and the deposit rate side?
I think this is where I go back to that liquidity question, the point on liquidity, because if you still have the banking system borrowing somewhere in the 80,000 to 1 lakh crore range on LAF, even if there is some policy rate reduction, I'm not sure banks will be immediately comfortable dropping deposit rates, because credit deposit ratios still remain reasonably stable and reasonably high. So if by the time you start having those rate cuts, you've already seen some reduction in the total bank borrowings, under LAF, then I think there is a strong case to be made for deposit rates coming down, and then of course passing on those lower deposit rates through lower lending rates. So I think it's a question of what comes first and then how it flows from then. But clearly, if you look at the next 6 to 9 months, provided liquidity has eased, you should see some rates, drop in rates happening.
So give us a sense of your credit demand. Have you seen signs of corporate credit picking up, or is it still predominantly retail that is driving credit growth for you?
If you look at the overall credit growth, you still have retail credit marginally outpacing the corporate piece, at least as far as we are concerned. Not a huge gap or not a huge difference in the growth rates, but there is clearly, the corporate loan demand or total corporate credit growth marginally lagging the retail piece. Of course, most of the wholesale lending is still largely working capital, trade finance, some medium-term loans, some term lending, but not really greenfield project finance at all on the table right now. On the other hand, relative to that, the retail piece has been chugging along at a slightly better pace. But overall, if we, with an expectation of about 5.5% GDP growth for this year ultimately, I don't think at a system level you'll see loan growth of more than around 16%, in which case the difference between corporate and retail growth may be a couple of percent, something growing at about 17, 18, the other growing at about 15. So that's the kind of difference in growth rates that we are seeing right now.
Paresh, a number of banks have become aggressive on unsecured lending. Now that credit conditions have stabilized, what is the sense given that HDFC Bank, you have a leadership position in the credit card segment?
Well, our growth rate is really not going to be a response to what others are looking at in this segment. In fact, you're probably well aware that even the last couple of years, when perhaps credit cards and personal loans were sort of out of favor for the larger part of the industry, we hung in there, and we've in fact continued to grow. although at a slightly moderated growth rate relative to 4 or 5 years back. But in the last year or so, we've seen much healthier growth in both these businesses. We today have a sort of widely segmented offering for different segments within personal loans. On the credit card front, we have arguably got the best offering in terms of the range of cards and the features that we offer. So both these remain important components of our retail lending businesses, and we are pretty hopeful that they will continue to grow at a pace marginally faster than, in fact, the overall retail loan growth.
Right, so give us a take on the recent moves on the amendment of the Banking Bill Act, and how will this move help you raise the voting rights for shareholders to 26%, and what's going to be the impact for you?
Honestly, not really, because this the whole issue of voting rights being in alignment with the shareholding is something which somehow is a lot which is made of that. But honestly, on the ground for an existing bank, and if you look at shareholders who would have a shareholding of more than 10%, the exercise of those voting rights is something which rarely becomes relevant. So I think it's important from a reforms point of view, and to the extent that it's seen as an enabler to perhaps the RBI moving ahead on new bank licenses and so on, it could have a systemic relevance. But specific to HDFC Bank, really not so much at all.
But it's the hallmark what has differentiated HDFC Bank from others is your margins. You've got the best ones, the best margins in the industry. So what is your outlook on HDFC's NIMs or net interest margins going forward?
Well, what we've seen in the recent past is that deposit rates, after having come off a little, have stabilized. On the other hand, on the lending side, there have been some increased competitive pressures, especially on the retail side. But by and large, I think if you look at our margins, which have remained in a range of about 3.9 to 4.3 in the last few years, we might see some movement within that range, but don't see really rates, our margins moving out of that range. In the more recent past, in fact, if you look at the last few quarters, it's been somewhere in that 4 to 4.2 range, if not the larger 3.9 to 4.3 range. And at this point of time, see no reason why we should be out of that range.
Right. In terms of asset quality, HDFC Bank has been one of the very few banks that has steered clear of bad loans. Have there been any fresh stress points in this quarter as well?
Well, at this point of time, if you look at the larger concerns on the NPA front, they've come partly from just the cyclical slowdown in the economy, and partly from the project or customer-specific issues that have hurt certain customers for sure. I think the cyclical impact is probably pretty much bottomed out. I mean, I think if we believe that from a bottom of about 5.3-ish, the economy starts moving up again, and hopefully from a 5.5 this year, we move to somewhere closer to a 6.5 GDP growth next year. I think the cyclical increase in NPLs has probably seen its worst. But the other issues, which are more customer specific, either relating to projects which have got stuck, or which have relating to very high levels of leverage specific to customers or specific to certain business groups, I think that has yet to completely pan out. From our own experience, our gross NPLs at the end of last quarter were around 1%, which are lower than our historical averages. Could we see some normalization over a period of time? That's what we've been saying for the last few quarters. We've been fortunate it hasn't happened so far. But we still believe that given our mix of loans, some normalization of credit costs or some normalization of NPLs somewhere between where we are and where our historical averages have been is logical. I'm not guiding to a particular number, nor do we have any trend that is very perceptible. But I think some normalization, I think, is something that we've certainly been factoring into our own internal targets.
All right, Paresh, appreciate your time and thank you for your insights. Let's talk politics and the impact of politics on economics with none other than Swaminathan Ankleshwar here, consulting editor with ET Now. Swami, good to have you back. Thank you for joining us. Swami, given the changing political dynamics, do you still believe that we could be headed for some early polls? Because now one is getting a sense that the regional parties and the Congress, they both are talking to each other.
There is a